Getting money from the bank to go and purchase an investment property is getting tougher and tougher. And so that is why a lot of investors are starting to consider, well, should I go and use a non-bank lender? But then there are a whole heap of questions. Well, how much extra can I borrow if I use a non-bank lender? What's the difference between a non-bank and a bank? And also, who are these guys? Hi, I'm Ed McKnight, economist here at Opes Partners. And in today's video, we're going to answer all of those questions. We're going to dig into who the non-bank lenders are, how much extra you can borrow, and who they are the best fit for. Now, the first thing to note about non-bank lenders is that they are not banks. There are a whole heap of services they don't offer that the banks actually do offer. But non-banks do offer residential mortgages, which is what property investors really care about. So let's get into what the differences are and the types of services that a non-bank doesn't offer compared to a bank. Well, of course, as we said, they do offer residential mortgages, but they're not going to do credit cards, revolving credits, overdrafts, FPOS and transaction accounts, or any term deposits as well. So if you want a credit card, don't go see a non-bank lender, go and see a bank instead. Now, we expect that over the next half a decade, non-bank lenders are going to become so much more popular over here in New Zealand with property investors. Now, why do we think that? Well, let's jump across the Tasman over to Australia and take a look at their mortgage market. 20%. 1/5 of the mortgage market over in Australia is made up of non-bank lenders. Over here in New Zealand, only 2% is made up of non-bank lenders. So we expect this is going to rapidly increase as banks tighten their lending policies and non-banks provide that solution for property investors or home buyers. Now let's talk about who these non-bank lenders actually are. Now there are a range of 20 to 30 different non-banks over here in New Zealand who you could potentially borrow from for your investment property. But here are the big boys. We've got Resimac, Liberty, Bluestone, Squirrel Money, Avanti Finance and Pepper Money. Now what's important to note is that while over in the traditional banks, ANZ, ASB, Westpac, those kind of guys, there's quite a lot of similarity between banks in terms of their lending policies and their interest rates. Well, over at the non-bank sector, that's not the case. There is a range of interest rates available. So what I mean by that is there are some people who will lend to more risky borrowers and they'll charge a substantially higher interest rate. But then there are some guys like Resimac who will offer an interest rate in line with most of the other main banks, but will also take that more conservative approach compared to some of the other non-bank lenders. Now, that's a big reason why you're going to want to use a mortgage broker if you're going to use a non-bank lender, so you can choose the right non-bank that's going to fit what you need. Now, one of the reasons that non-banks can potentially offer more money is they take what's called a pragmatic approach, or they will look at your application on a case-by-case basis to decide, are we going to approve this or are we not going to approve it? What that means is there aren't any hard and fast rules about what they will approve and what they won't approve necessarily. Whereas with the main banks, usually there are some set rules that we can tell you, not the case with non-banks necessarily. So what I want to do to give you a sense of what's possible with a non-bank is take you through a case study of a real couple investors who we worked with here at Opes Partners and with our sister company, Catalyst Financial. So these guys were a couple, no kids, living in Auckland. They were renting, but they had 3 investment properties already. One partner was earning 100K and the other partner was earning 90K, so 190K household income all up. Now their ambition, what they wanted to do was purchase an 800K property in Auckland, a townhouse, which would rent for about $650 a week. So let's look at what the banks would lend them, and this is before most of the recent servicing changes. So before debt to income ratios became more of a thing, and before the Credit Contracts and Consumer Finance Act was implemented, which meant that bank lending started to tighten. Well, there were 3 banks, BNZ, ASB, Westpac, that were willing to lend them that 800K. ANZ, bit more, 850K was what that bank was willing to lend. And what's interesting here, Pepper Money, the only non-bank lender on this list, was willing to lend 840K. Now, why is this interesting? Well, the non-bank lender wasn't the lender or the institution that was willing to offer the most money in this situation. It was actually ANZ at 850K, 10K more than the non-bank lender. Well, let's look now at what happened after the banks changed their servicing criteria, after DTIs started coming in at BNZ and ASB, and after we started to see ANZ and Westpac start to tighten up their lending criteria. The amount that the banks were willing to lend dropped significantly. In fact, ASB, 290k difference compared to what they were willing to lend after compared to before the servicing changes came in. Only Pepper Money did not change how much they were willing to lend to this borrower at 840k. But what is interesting and what might surprise you is that is not necessarily substantially higher than the closest main bank, ANZ, which was willing to lend 800k. There was only a 40k difference between what the non-bank was willing to lend compared to the main bank. So while some people think, I'm going to go and borrow all of this money, millions of dollars from a non-bank lender, not necessarily going to be the case. They might give you more money, or they might be willing to lend you more money compared to a main bank. That could be the case, but it's unlikely to be millions and millions of dollars more. Now, the whole reason that a non-bank lender might be willing to lend you more money is because they take a pragmatic approach and they have what they call risk-based pricing. Now, what that means is that if you are the sort of person who would get approved by a bank anyway, you're going to be charged a similar interest rate to what you would by the bank. But if you're considered or perceived to place more risk or come with more risk, they're going to charge you a higher interest rate. Let's dive into Pepper Money, that non-bank lender that we just talked about, and look at the difference. So for prime customers, they're willing to lend at about 3.29%, or at least I should say from 3.29%. For people who pose a bit more of a risk, well, that could be up to 5.55% per annum, so quite a bit higher. Now, you might be thinking, well, who are non-bank lenders the right fit for? Hey, look, they work really well for people who are self-employed. So when you go and apply for a mortgage from one of the main banks, you've got to apply with 2 years worth of financial statements. Well, if you've only been trading for a year, your business has only been going for a year, or it's only started to ramp up over the last, say, 6 months, well, then it's unlikely that your financials are going to be accepted by one of the main banks. But if you took those to a non-bank lender, they can take that more pragmatic approach. Because of that, you might get approved. Similarly, they work really well for people on variable income. So that could be people whose hours aren't necessarily locked in, but also people who earn bonuses or commission. And because of that, their income is going up and down. Well, a main bank might only look at your retainer, your income that is consistently coming in, or your base, some people call it, whereas a non-bank lender might take into consideration the whole amount. Now, you might be thinking, well, okay, I'm interested in a non-bank lender, but aren't they going to charge me a substantially higher interest rate compared to the main banks? Well, not necessarily. And again, I'm going to give you a case study on this. So let's think about those people we just talked about, that couple on 190k household income. They want to buy their fourth investment property. Let's look at the actual rates they were offered. Well, ANZ at the time were willing to offer 3.45% per annum on a 1-year fixed rate. Pepper Money, the non-bank lender, only 0.1% more than the main bank. They were willing to offer 3.55%. Now let's look at the floating rates. ANZ up around that 4.59%, whereas Pepper Money substantially lower at 3.6%. Now the key thing here is that they are not that out of whack necessarily, or at least not in this situation. So this idea that non-bank lenders are always going to charge substantially higher rates than some of the main banks, not necessarily true. Would be true if you weren't a prime customer, if you pose a bit more of a risk, but then again, if you're going to a non-bank lender for that reason, then a main bank isn't really an option for you. But interest rates aren't everything as well, and so you do need to consider the additional costs of using a non-bank lender. First of all, if you go to a main bank, they're probably going to give you a cash back. Now that is going to go towards some of your legal costs, and it might be something like 3k. If you go to a non-bank, you're not going to get a cashback, and in fact, you're probably going to be charged an establishment fee, for example, of 1.5k. This might end up being discounted and could include some other services like a valuer, which you need to pay for anyway, but there may be some initial setup costs. In addition to that, you might be charged a monthly fee of, say, something like $10 a month. But what you do need to consider is if non-banks are the way that you're going to keep investing and there's an option there to borrow to purchase the next property, that might be an additional cost that you're willing to pay so you can keep investing. Now, if you want to learn more about property investment here in New Zealand, check out the Property Academy podcast, because every single day we release a new 10 to 15 minute-ish episode to teach you something new about investing in property right here in New Zealand. You can find that on Apple Podcasts, Spotify, or your favorite podcast listening app.